Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Spencer Hilligoss. He is a passive investor who runs Madison Investing, a club where limited partners gain access to the same type of niche investment opportunities where Spencer deploys his own money, including cash flowing assets like self-storage, multifamily, and private credit. He has deployed 7 figures of his own capital into investing in the past 7 years. And in 2019, Spencer retired from a 13-year leadership career in a Silicon Valley tech company to focus on serving fellow investors at Madison Investing. Spencer, I'm looking forward to hearing your story and sharing it with our audience here.
Yeah, honored to be here, Keith. Thank you so much for having me on.
Yeah, thank you. And I always like to start with really your background. Where did you grow up? What eventually led you to this world of investing in real estate?
Yeah, I mean, as a kid who grew up playing in punk rock bands and thinking I was, pretty cool and never going to be interested in business, it's strange, the journey and the chapters of life that you embark on, right? So to your point, I went through a technology career, but that was coming from a real estate household. My dad was a broker for 30 years. And I was doing odd jobs for his brokerage when I was a kid. I don't think you can count experience as, a 6-year-old sitting there on a plot of land. But when I was a teenager, he had me, running open houses and cleaning out fridges for properties when he was trying to prep them. So I got to see kind of the inside of that very narrow lens on what real estate could be, because it wasn't really the investing side of it. And I'd learn that later. But flash forward to, my corporate career, I was in these fintech, financial tech companies, and I still didn't really get it, from an investing perspective. I was doing the traditional path, Keith. It's like Jennifer, who's my co-founder at Madison, and my wife, she and I were doing the dual income, no kids for a while. Eventually we started growing a family, maxing out our 401ks, really patting ourselves on the back for that, feeling good about our trajectory. But ultimately, I was in, I think, my 4th startup when our second kid was on the way. And I was grinding. I was grinding 80 hours a week in office, not including the time at home, opening up email at the end of the day and the kids are in bed, just wondering, something's got to give, and ultimately that's what sparked the interest in me to kind of go let's go find a different path. There has to be an off-ramp from this. I was getting, promoted, which feels good. It feels good to get that 3 to 5% bump every year.
Yeah.
But then going man, we were chatting about this before we hit record today, Keith, but I live in the Bay Area, California, pretty pricey market. It's not like we were sitting there flush with cash, so much so that I could just retire. I had to figure out a way, how do I flip the priorities here? And so a mentor of mine actually brought me into a real estate tech company. It was the last one that I was at before I quit 5 months before COVID, and to go run our investing club full time. And I'm so damn grateful that he did, because I got dropped into the guts of a fix and flip lender. And it was all new language to me. Even though I'd grown up in the real estate business,
right?
I didn't know the first thing about loan to value. I didn't know about what it meant to make a bridge loan. Or lo and behold, I got deep into it, and we ended up doing over 600 loans per month to fix and flippers and learning what the heck that meant. But I was like, I got to somehow find a different angle on like, how do I get involved in all these zeros that I see that these flippers are getting, but I can't swing a hammer. I thank God for YouTube every day, just around the house. And so, long story short, I wanted my approach into investing, and I found that looking at bigger properties. Like, I'm an operations guy. I like predictability. I like to map things out. So I devoured 400 podcasts in 18 months. I've read 24 books, like way more, way more than anyone really needs to do.
Yeah.
But in hindsight, that's what lit the fuse for me. Was like, I'm going to go start investing. And so we bought a rental locally, too scared to buy sight unseen. Realized $100,000 down isn't exactly going to change our life when it only produces $200 a month in cash flow.
Yeah.
It's great. It's hard to find a break even in general on a rental property here in California. So we were just pleased with that, but our dollars were going to run out. So we had to go and buy somewhere else. So we got up to 5 single family rentals in the Midwest, bought those in Kansas City. Better economics. It was like, I think like average $60K a pop, mind-blowingly cheap for those of us on the West Coast, and $250 a month in cash flow on those. So we kept taking these steps, and it was like step 1, buy local, too scared to buy sight unseen. Step 2, build this little portfolio we had in the Midwest. And then we were like, oh, the tenants turn over all the time. Like, we're going to crush our economics on that $250 a month instantly when someone wrecks the property and leaves at the end of the year. And so,
for sure, yeah,
we wanted something passive, man, and busy life. So we started investing at LPs after that, and that was the journey that led us to where we're at with Madison Investing, and also with our own capital. We started investing as LPs, limited partners, in multifamily deals, self-storage deals, and ultimately more diverse stuff, even just getting into like private credit, which was a big focus for us now. So it's been a heck of a ride, man. And I'm just so deeply grateful for the learnings along the way. But of course, some of that tuition, as it were, that you pay, not just because you're getting a good deal. Like, the last 2 years, it's presented some pretty challenging moments as well. And so also getting the tuition of like, here's what not to do. Here's how I should not be investing. Here's who I should not be investing with. But I'm just grateful for the journey every day.
Yeah, it sounds like quite a journey, and it's not unlike a lot of investors, especially with this first rental, and kind of coming to that realization where, gosh, I'm putting down $100,000, and here I'm getting $200 a month, and like you pointed out, you get one person that moves out, and all of a sudden there goes all that cash flow for the year, and you're starting over again, and you're probably going to be seeing the appreciation throughout that time frame, but a lot of times it's has you questioning, what am I doing here exactly? And then going into a different market, I commend you for that. Having the bravery to go outside of your backyard and finding a better deal. And it sounds like it was with now you're making $250 on each of these, and you've accumulated 5. But even that, then you opened your eyes to the limited partner avenue. What was the first limited partner deal that you did? How did you find out about it? Tell us a little bit about that.
Yeah, God, I was networking like a madman. I was going to local meetups. Initially, I was on my lunch break from work, and I was like, "Hey, I'm going to go just walk down the street." Thankfully, living in the Bay Area, but working in San Francisco, I would walk down the street to a number of different real estate meetups that were nearby, and I realized, okay, learning the lingo, more so understanding how people look at these deals. But I eventually was hitting up, like biggerpockets.com, the forums on there, and connecting with folks online, and then taking it offline. And that's how I found my way toward a deal that was in Alabama, Huntsville, Alabama, multifamily deal, and put in a modest amount on that one. I think it was only like $25,000, which was not chump change for anyone. Of course, don't care how big someone's net worth is, but that felt like a lot to us at the time. And the first time is so emotional, but it went really well. And it ended up exiting with some help from the tailwinds in the market. We exited that one in like 2.5 years, more than doubled our initial capital investment. And I'm sitting there going, wow, like, okay, so this is something special, and we should be looking more at this category. But that's how I found it.
Okay. And then from there, did you get into another limited partner deal on on another multifamily, or did you switch asset classes, or same group? Or tell me a little bit about kind of your progression before you decided, hey, we've done enough of these. Man, I need to get some other people involved.
Yeah. I'm a big framework guy, and I've learned from, particularly the most hardcore of early stage tech startups that I've been a part of. I was just humbled by how many brilliant people were around me. I felt like the guy who got pulled in, surrounded by these absolute badass professionals, and academically and otherwise. As the kid who went to University of Colorado Boulder, go Buffs, and liked to snowboard in college, I'm sitting there going, how do these guys make these smart, complex decisions quickly while building a really complex business? And it's frameworks, and frameworks that at a high level have informed me, like, okay, I need to make great decisions. Great decisions are usually made slowly, but we don't have that luxury. So how do I make great decisions quickly? And that's where the frameworks come in. So Jennifer and I, after we did that first investment, we were like, we need to get serious about how we due diligence these things for our own capital. And we still use this 5-part framework today when vetting sponsors looking at deals for our investing club, but we've obviously built this out in a much more robust way, especially after the last 2 years of learnings, and applied those to the framework. So the buckets are this. It's like, number one, track record. What have they done? Number two is approach. Like, how do they execute? Number three is the team. That is, who is running the show, and how is that set up? And number four, communications. How do they communicate with investors? And number five, values, which I'm sure sounds squishy to all the pure quantitative folks out there. And we're happy to go into those. But, that framework has served us so incredibly well. So before we started diving into more deals, which we did, we looked at multifamily, we looked at self-storage. We're particularly grateful that we leaned into self-storage around like 2019 or ish, or mid, actually even earlier. It was like maybe late 2018, early 2019-ish. And really caught a great wave with that. The values went bonkers in a good way in 2021. So we invested in those asset classes, and syndications, single asset deals like that, or funds. Particularly on the storage front, because a lot of those storage facilities are just smaller. They don't cost $10 million like a couple hundred unit property in a multifamily.
Right.
So storage, you see like a big fund full of a bunch of properties, but we started doing that. It did invest beyond that, invested in a mobile home park, which actually ironically ended up being one of the best exits we had as an LP in the past year, of the very few, because the market interest rates have been so high. There hasn't been that many exits happening, man. So, really grateful for that, but that's really where the journey led us. And I think the club came about organically, because in the end, I had a mentor who asked me this really pivotal question. And this is not a real estate person. This is just like a guy I've known for years. And he's like, Spencer, you got to consider, what type of involvement do you want in this stuff if you're going to go build this club? Because I thought, hey, let me go pay, an exorbitant amount of money to join a coaching program to become a lead sponsor, a lead GP, become the person who's sourcing these deals and doing all that stuff, becoming the senior leader, right? And he was like, do you live in a money state or a deal state? And I'm like, well, I don't know what that means. He's like, well, you're going to source the deals yourself. You're going to go out to these markets where you like to invest, fight tooth and nail for the deals. Is that something you enjoy? Because some people do. Yeah. Or do you find you want to apply your expertise and your network to partner up and bring capital into those deals? And that's where I made a pivotal decision to say, man, I had everybody in my network reaching out saying, man, that deal you were in sounds great. How do I get involved? And I don't want to hop on a plane, Spencer. So, how do can I lean on you? Can I lean on you for due diligence? Yeah. And that's where it came about. And, we ended up building the club from that ethos of same framework that we use for our own vetting on the sponsor level, because that's what the big learning is. I can't take credit for this, Keith, but like, you look at the team, you look at the market, and you look at the deal, or AKA the business plan. And that has been such a great fit for like what I find interesting, in addition to bringing strengths together to partner with a very short list of sponsors that we've gotten to know over time. So that's it's been a labor of love, and I'm grateful to be able to work on that in partnership with some good teams that are based in the Midwest, based in the Rockies, and based in the Sun Belt.
Okay. And maybe we can go through some of those. Obviously, you've got the kind of the basic framework here, and track record, kind of self-explanatory. But what are some of the things that you like to look for when it comes to somebody's track record?
Yeah, man, happy to nerd out on any one of these to any level of depth. But there's a few I think that are really pronounced now more than ever.
Yeah.
So we've gone back. The 70-row spreadsheet that backs up each of these buckets. I look at track record very differently now than I did back in 2018. And of course, track record in a basic sense for any first timer that's figuring out which way is up. I was literally just talking to a new club member at our club this morning. He'd never done one LP investment before. And he's like, man, I'm overwhelmed. I'm like, that's normal.
Yeah.
That is normal. Look at the track record. What that means is I'm going to invest in this sponsor, trust him with my hard-earned money. Have they done this before? And show me the properties. How is the outcome? I take that a step further now compared to 2018, Keith, because there was that magical time of 2021 where so many relatively new sponsors, they exited huge positive outcomes. And that was because the market tailwinds were strong, all that printed money from the Fed and from, spiked values. So there's a bunch of sponsors that have incredible looking track records on paper, massive IRRs, massive returns for investors, but they're good. But are they great? And are they capable of protecting the downside? Because now what I look at is coupling that with the approach. And the approach means I can't have one without the other. Approach means that team has not only done this before, but if they're a self-storage sponsor, let's say, they say, hey, come invest in my deal. Invest your $100,000. We're going to go buy these self-storage facilities. We're going to pack them together in a self-storage fund and eventually exit it, sell it to a big institutional buyer. Be like, okay, you said a lot there. Walk me through how you've approached doing this in the past. And if I'm learning, I'm a big guitar nerd, if anyone has learned an instrument, if they've learned a hobby, a trade, if you've gotten any kind of skill, you've worked, at least I'm not a savant, I've had to work hard for that. So if I could play a guitar solo, I have had to sit down, methodically walk through, practice hours and hours. And I can tell you every single day, an hour and a minute I've spent practicing and how I did that. And same thing goes for a sponsor. If they are going to go out and say, here's the biz plan for that storage facility or that 30 self-storage facilities. Here's how we did it before. Here's how we're going to go do it again. And that means on paper, clear, where they get the materials to go do some improvements, relationships they've used in the past for labor. How are they sourcing the deals themselves? What's their acquisitions playbook? And that way it de-risks that track record component of saying, hey, that sponsor caught a positive tailwind. And yes, they're good and their track record looks great, but I can't be sure that going into a recessionary period, they could pull that off again if the winds turn. And so that's kind of how I think about it differently now.
Yeah, I think that's good. And you're right. This time frame, this has been unfortunate for a lot of folks. And to be fair to a lot of folks, that deals didn't go quite the way they were hoping. It's hard to see that big of an increase in interest rates. It's hard to know that where you were able to use bridge debt on certain deals and get away with it, that this was going to get you caught, right in the middle of it. It's hard unless you've been through it, right? So they can catch a lot of people by surprise. But I like the idea of this framework that you've put together, and I think that the approach between the two really makes a huge difference. Are there some other things in addition to the approach, the track record, that you've learned, and I'm maybe thinking communication, but I don't want to get ahead of it. But are there some other things that you've seen from maybe investing in deals that didn't quite go right during this most recent time frame? I just hear in my communications on this podcast with other investors and other people, a big thing when it comes to communication. Where communication, unfortunately, in a lot of deals over the past year and a half, 2 years, has shut down when it should have been doubling and tripling down on the communication and making sure people knew what was going on, what they were doing to resolve any potential issues that they were going through.
Oh my goodness, do I agree with that one? Yeah.
Yeah.
I mean, Keith, so well said. I think on the doubling down, even going back to my corporate career, it's like akin to crisis communication. If a company is going through something really challenging or there's some drama, there is a specific person usually tasked with that, who they step in. And same thing with governmental organizations, right? Like the playbook is, if something's going off the rails, this person steps in or this playbook kicks off. And that means more frequency. That means complete transparency. And that means delivered in a timely fashion, like without weird delays. And so that is what I absolutely would expect. And when going into a new investment with a new sponsor in particular, it's so easy to do this due diligence, I feel. It shouldn't feel weird, in my opinion, to go up and say, hey, you mind sharing the examples of just like your most recent communications on a handful of deals, 3 to 5 deals. And ideally, if I've talked to them before, I've got some rapport, I can ask them very point blank, like, tell me about a deal that didn't go well. And I tie that back to communication, Keith, because I want to see that communication too. Like if I can see, like, how did you actually let folks know you're trending toward a pause distribution or trending toward a capital call? Like it's okay to ask those things, and I think so often I talk to new LPs and they're almost hesitant, kind of sheepish to be like, oh, I don't want to offend. Be like, yo, this is not the time for that. This is your social graces will be very much intact by just asking that question. And if they don't want to give it, you've gotten all the answer you need.
Yeah.
It's okay to walk at that point. I did want to share, I think on the team front too, Keith, the interesting learnings on the team themselves. One of the things that I think is key when I look at a team now compared to back in 2017, 2016, 2018 is like, how is that team comprised of the GPs themselves? Like, do you have one person? So right out the gates, if there's a single GP at the helm, there's no counterbalance, there's no redundancy. That's not a deal breaker, but it's certainly going to need to have some kind of mitigated risk component there. Like, what happens? Life happens. And I'm not trying to be too grim, but like, people get hurt, people get sick, people get in trouble somehow. And what happens if that person goes away and they're in charge of managing 20 to 30 to 50 to $100 million? So, all right, more than one GP is a good thing. Beyond that, would love to just encourage folks as well from this learning. It's painful, but I would say that if that person has passed every background check and civil background check, criminal, civil, and they always do, frankly. I've never run a background check where it comes back exciting, which is a good thing.
Yeah.
But the whole period of 5 years, 7 years, 10 years, life is lived in chapters, and sometimes people change under duress, under stress. So I want to know, like, do the partners themselves, if there's 2 or 3 or 5 GPs in that team, are they business married, and do they know they're business married?
Yeah.
Are they? Because this ain't going to be easy. Like this is going to be something that figuratively kicks them in the teeth and drags them through the dirt a little bit. And are they together enough to be able to see this thing throughout? Because people get hostile toward each other, and they could be best friends at the start. That's when they're winning. Yeah. When they're not winning, what are they going to do? And so I look at the team dynamic is very important on that front too. In addition to things like more cut and dried, like do they use in-house property management? If they're a multifamily sponsor, do they use third-party property management? I'm not the guy who says one is good, one is bad. I know some folks are staunchly against third party. Some folks are staunchly for third party. I think of it as a tool. And like the issue I take is that when we had one investment with a sponsor who I really appreciate, but they made a call and learned from it. They don't want to manage. They don't want to be property managers, but they tried to go integrate and be vertically integrated. And that was a bad call. Wasn't fit. They came back around and went back to third-party property management. Best decision they could have made. And I really just wish that there was an openness and due diligence for folks just to be like, you know what? This firm is not vertically integrated. I'm not going to ever invest with them. Be like, hey man, more power to you. I think that's a very myopic view. And it comes down to, are they self-aware enough to know what tool to use for their fit of their approach?
Yeah, no, I couldn't agree more. I think that when it's possible to do it, I believe as a GP, it kind of gives you some level of control, but having that level of control, if you're not the best at it, isn't necessarily a good thing.
Right.
It's maybe better to shift that control to somebody who that's all they do, is the property management, and they're better at it. So I think you can certainly, I like the idea of it being opened to, what works best for that particular group. So
totally.
And so tell me a little bit about how this investment group works. You're sharing with folks kind of what are you guys getting on calls together and listening to various pitches, and then discussing them afterwards, or what is Spencer? What does it look like when you're sharing this with?
When we first started, and even to now, intentionally built long-term relationships, and I mean this in like the boring way, the old school way. And as a guy who comes from tech, maybe that sounds counterintuitive, but what I've learned already is you want to invest alongside people that you enjoy the company of. Mm-hmm. And, these are 5-7 year hold periods, and life is too short. And in the end, I meet with 100% of the new members that join our club. We don't charge a fee. But I don't do this pro bono, like we're a for-profit business, but I would just share in the promote, in the GP proceeds when the thing goes full cycle. And, the way we typically will go about it as well is like, we want to source the strength in numbers. So if we have, millions of dollars that our group is collectively investing into a great looking fund, I might put together like a feeder fund, and then we're going to go invest into this other fund together to get more favorable terms, like a lower investment minimum, better split, waterfall structure. So we get like a 90-10, 90% for the LP, 10% for the GP instead of a 70-30, because we're bringing in one larger check together. And that is what we'll do from time to time. As well as I have decided to still get active with a very short list of partners. So I'll just join them in the GP team on certain deals, but I don't do that very often. But we will still do that. We'll all join on a deal, and just only very much with teams that I've gotten to know over the course of years. Because I had to learn my lesson a couple of ways throughout the past 7-8 years.
Yeah, exactly. Well, no, that's good. Now, for the audience, just to kind of share a little bit more, I mean, you're bringing a lot larger checks because of the way that you're structuring these. So sort of like a fund of funds, you're
exactly right.
You're coming in and you're saying, hey, look, we can write a big check, but let's sit down and let's create some more favorable terms. And then you're passing that along to your limited partners.
That's exactly right. Yeah, and done correctly, putting on my lens and my hat of an LP, I only would want to do that, to cut a check for $50K, $100K, if I knew that investing into some form of fund to fund or feeder fund was going to produce a better net return than if I just went direct. Like that is why. So if I can't rationalize that, if I can't make that case on paper, I'm not going to do it. It just doesn't make sense, But I do want to share though, Keith, that the joy that I derive from this is really connecting and learning alongside people that have such vastly different stories in life and entrepreneurship and business than I ever have. And I mean that, it's been fulfilling to the core to get to know someone who's like a 3rd-generation company owner based out of Georgia, and they do something with physical goods or like metal recycling, or a business owner who actually created like a snowplow business based out of Philadelphia. Like these are dramatically different experiences in the way that they look at deals, the way that they analyze the macro environment. Those conversations are enriching on both sides. And that's, when I first talk to folks though, the uniform number one guiding principle that I have to remind myself of as an LP on every single beautiful looking investment summary that I look at, because my lizard brain kicks on, is like, oh, look at those pictures and look at that eye-popping IRR. That's crazy.
Right.
And then I sit there and I go, okay, what was my goal again? So like, what's the goal for the money is like the most powerful question. I swear to God, it's like not the it sounds so basic and it's easy to cruise by for those of us that have been doing this for a while and investing in the space for a while. But it's still just as hard today as it was when we first started investing in this stuff. What's the goal for the money? And like reminding myself and forcing myself to look at that beautiful investment summary as the deals come into the inbox and we're sitting there going, wait, yeah, that's a great IRR, or on that development deal. Am I going for a certain dollar amount of cash flow per month within the next 5 years? Wasn't that my goal? So if I'm talking to like a Apple software engineer in our club, and he's like told me already he's got 2 kids, not planning on retiring, generally enjoys his work, planning on sticking around there, making over $300,000 to $400,000 W-2. And I asked him, you said you're a cash flow investor. Can I ask you why?
Yeah.
Just curious, and more power to them. But like when they say, I want more cash flow, I'd be like, are you going to pivot? Because cool. Like, are you going to build your own startup in 3 to 5 years? Are you going to try to move out of country and perhaps, house the next generation of parents above you? Like, these are real stories from people.
For sure. Yeah.
It's that goal setting that I think gets lost a lot of times when a beautiful deal comes along and you're like, there goes the rational, the rational analysis,
Yeah. Makes sense. Yeah. Because depending on the deal, it's going to be structured differently. And sometimes it's more of a play of getting, that big bump at the very end or almost in the entirety of it, or it could be, a little bit more balanced, or it could be cash flow. So it's really, and what does your group focus on, or are there different people that have invested in different syndications with you that you look at and you say, well, this is more for our cash flow guys. This is more for, somebody who's maybe more looking for that appreciation at the end.
More of the latter, which is really just point blank pros and cons, right? Making a good old T-chart. For cash flow investor, I'll just highlight that. It'd be like, hey, this is a fit, right? Quarterly distributions, monthly distributions. So does it produce income? What's the downside protection? I think that talk about key learnings from the past 5 years or 2 years in particular, Keith. It's like the way I look at downside protection now, including, of course, to your amazing point earlier about the debt, the bridge loan, right? Like, that's just one example of, man, have invested in a killer deal, great asset, great market. Man, there was like a little ticking time bomb there that even though as an investor, there's a snapshot in time that said, this deal looks great based on all current data. Well, there's going to be new data coming and you're not going to like it. So how, going back and thinking, okay, for a cash flow investor, how can I present all those pros and cons and variables on cash flow predictability and downside mitigation? But on the other side saying, okay, for folks that just want to grow, how do you want to grow and what risk profile? Like, does someone want to swing for the fences and go for like a 30% IRR target on a development deal, knowing that bad boy is starting with a big empty plot of land and a dream? Right. And that's why it has this incredible risk and reward profile. But I'd say generally my leaning now, having gone through some really great wins, like we've had, I think at this point, 20 full cycle exits. And, the majority of those went well. We had, 5 exits in 2024 that after a very long dry spell, 2 of those were home runs. The other 3, we were thanking God that the capital came back.
Yeah.
Just to be blunt, and that's the environment we've all been living and working in. And I look at that like, wow, one of those deals got a 1% IRR. I'm thrilled.
Exactly. Yeah.
And so for the folks that are new coming in, you're like, oh my God, I hope that does give folks pause, at least from a goal setting perspective, not to invest, because I'm still here and this is a part of this is the ride, man. Like, this is part of riding the market, investing with a kind of a dollar cost averaging mindset, just like within the stock market. Always be investing is my ethos as well. And like, I try to just ensure folks know, don't swing for a 30% IRR if you're a cash flow investor. Go for the things that are more conservative. And that's why I've been leaning more into, okay, still love self-storage, boring asset class, boring asset class to the core. Haven't had a pause distribution on the majority of those that I've made in the past 2 years. uh, private credit, that term didn't make a lot of sense to me at first, and it means 1,000 different things. For real estate specifically, all that really means is becoming more like the bank. And right now, actual banks are lending less and charging more. So, and if there's great deals out there, I want to invest on that side of the balance sheet where I can go and become more of like the private lender and still get a good return and have some downside protection. So those are kind of a couple of the areas right now that we are leaning into. We did close on like one single asset deal late last year in like November, out in the Midwest, but like boring business plan, just not doing anything crazy, kind of done, losing money on a couple crypto investments. More power to all of the crypto investors out there that are really happy, and they should be, for their Bitcoin trajectory in the last year. But boring sounds great to me right about now.
Yeah, I'm sure. So, yeah, let's dive maybe into that private credit a little bit more. What type of lending is that? I mean, is this taking the place of the bank? Is this for like fix and flip type loans, hard money type loans? What attracts you to the private lending side of things?
Yeah, I think my first foray into it, Keith, was when I was at that last W-2 gig in my tech career, and getting to learn the guts and just the mechanics. Vitally helpful. Seeing that on a single family home fix and flip project, learning what a scope of work means, learning like, oh, there's this maximum point of risk after you gut a property before you start making that rehab, when this could go really well or this could go not so really well.
Yeah.
So seeing that and then realizing, oh, wait, it really is very similar if you apply this to bigger deals. If you abstract it back far enough. And the type that I looked at, this is at the end of 2023, scoured the market to look and say, okay, how do I get on more of the lending side? But in a way I'm a guy who does want to stay passive wherever possible. And I wanted to stay within commercial real estate because I think that commercial real estate still has this moment where it's like values are depressed right now. Banks have pulled back. Great sponsors are out there. They're buying. I don't necessarily care for rescue funds and debt, like distressed funds. I mean, I think that is a very rapidly grown category.
It is. Mm-hmm.
I think that there are good ones out there, I'm sure. But I looked across and stack ranked these ones that were doing maybe the senior loan, replacing the senior loan. But that actually ended up being one where it's a preferred equity focus for us. And the preferred equity focus is like $1 to $5 million checks being, funded out there. I'm not the fund manager on this. It's a fund to fund that we ended up going with right now for the current one we're doing. But it's a mix of great assets in commercial real estate. Just some multifamily, but also industrial, some retail. Medical office. Fan of medical office as well, just from past investments I've made. Nice, boring asset class, really stable tenant bases and stuff. And so that's really been it. Which is like kind of getting almost hard money like returns or profits at these big check amounts, but you still can not only have good returns, you can even have like takeover rights if they don't pay, but I think the thesis for multifamily demand as an example in these asset classes is still incredibly strong as long as you take office out of the equation. Right. Office is kind of its own challenged odd duck out because the nature of work is changing fundamentally at a societal level. But
right.
all that to say, I really still think that like people need places to rent. That's not going to change. So we want to invest into some of these deals where you can still kind of help on the acquisition and get some good profits out of it.
Yeah, makes a lot of sense. And how about on the self-storage? What are some things maybe on the self-storage that you look at when you're either evaluating the operator or going back to kind of the approach?
Right.
What is it about an approach within self-storage that you're kind of looking for to check the box to say, yeah, I believe this is probably a good approach?
Sure. So we've invested now in 3 self-storage sponsors to date and made a bunch, across each of those. And I think that the playbook you see in the broader narrative within self-storage as purported right now has been the great consolidation. I think that narrative, by the way, you can hear across a bunch of other asset classes and part of the business world, but as it applies in self-storage, the great consolidation means you've got mom and pop operators out there. They've been doing this for decades.
Mm-hmm.
They have left a lot of meat on that bone in their properties.
Mm-hmm.
So they haven't raised rents. They haven't been advertising to keep them full, et cetera. So the playbook that made sense to me 2018 still makes sense to me now. You can approach those, like we're looking for sponsors that can know that playbook to approach those sellers, buy the property, add value in the ways that you can, which is modernize the heck out of it, reduce expenses with technology stack and increase your revenue. And that playbook has worked. I think right now is interesting too, because it's a really tough moment for most of these asset classes. That means you can get some stuff at a discount if you can compete to win it. But that narrative of the great consolidation ain't changing. Like there's been some huge mergers and acquisitions in the top 5 for storage owners. So any operator amongst those 3 that we have invested in and beyond who says, we're going to go buy, maybe do a little building too, put them into a fund, sell that under one marquee name, one brand name to an institutional buyer at the end. That's a playbook that I see, and I see it working. Of course, the dynamic at play that's absolutely part of the consideration set right now, Pete, is that I don't think anyone really understood. I'll admit I didn't understand necessarily, but I am certainly seeing it now, how tightly linked that these single family home market dynamics are to self-storage. So like no one's buying and selling homes right now. And they haven't for like 2 years. And it's because of the interest rates and the pricing. And that is really important because the self-storage demand and the occupancies and rent rates, that ebbs and flows with how often, Americans are moving. And, all that to say, there's a lot of pent-up demand. So a good moment to buy. Get ready for whatever kind of liquidity moment's going to occur in the market, and all the transactions start to increase as the single-family market unfreezes, whenever the heck that's going to happen. So here's to, knocking on wood, here's to some years when maybe the mortgage rates can at least get some relief. Right. We're never going back to whatever that free money era was, closer to 2020. But here's hoping.
Yeah, for sure. No, that's great. And so beyond those, do you see anything else out there that maybe you're not comfortable investing in yet, but it at least is on your radar, or maybe it is something that you're thinking, in the future it'll be something I'll look at a little bit more close.
Yeah, looking beyond real estate into some alternative asset classes, I have invested in some, been burned by some. I think that oil and gas is one that I get across my desk every week right now. Folks saying, hey, what do you think about this? What do you think about that? And I've heard people have great experiences. I've heard people have very ungreat experiences. But I could say the same for every single asset class. So I think the ethos I'm sticking with right now is like, stick to what I know well, Keith.
I think that's good. Yeah.
I think I try to take a long ramp on, and when I do, things generally work well. If you really take your time to wrestle with a concept, to wrestle with an asset class, to get to know the players in it deeply, all that stuff. But I'd say right now, that would be one of the asset classes that I still think I'm circling. And I certainly find the tax components of that compelling. That's for sure.
For sure. Yeah. It's it's one of the few, right? That, you got somebody that is maybe the high income earner on W-2 still has that ability to offset their W-2 income. There's just not a lot out there that will allow you to do that without being a real estate professional status or one of those. So
totally.
But it's oil and gas by itself. There's just so many different avenues within that, and is so many different levels of risk. So yeah, it's one I haven't done myself, but I keep having guests on, and I'm intrigued at least. So
yeah, me too.
Yeah. So, well, this has been great, Spencer. It sounds like you guys are really doing some cool stuff, and you're taking people along with you on that journey, and really creating a community around investing, which I think is good. It always makes it a lot more fun to do as a group, and so it sounds like you're doing that. How can people find out more about you if they want to invest with Madison Investing and get involved? Yeah,
and thank you, Keith. This has been awesome. Folks can find us at MadisonInvesting.com. wealthflow.com. There's just an option to request an invite on the page, and then they can set up a time on my calendar.
Perfect. Sounds good. And I've got 2 more questions I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
Absolutely. I'd say that 2 powerful phrases. Number 1 is that there will always be more deals. It's very emotionally compelling on that first one. Just remember, there's no generational moment happening in front of you. There will be more deals. Take your time. The second would just be that same question from earlier, but really taking the time to wrestle with it, which is, what's the goal for the money? Like challenging oneself to get a time-bound number. If someone's cash flow focused, how much do they want coming in and by when? If they're growth focused, how do they want that thing to grow? That 50K, 100K. So I'd say that would be it.
Yeah, I think that's great advice. How about a book recommendation? Doesn't have to be real estate related. It certainly can be. Just something you've read that's been impactful you want to share with the audience.
Gosh, the number 1 book that has had the biggest impact for me in practical terms is called Essentialism by Greg McKeown. It's not brand new. I think it came out probably, 15 years ago, something like that. That book helped me immensely, specifically when I was deep into my tech career and I was also learning all this investing stuff on the side. It teaches you ways to say no, 5 ways to say no in service of higher priority that you need to focus on and keep your social graces intact. It's not fun to say no to a friend that wants to go to happy hour, grab a coffee. But sometimes you need to go focus on the number 1 priority in your life, and everyone's got the same 24 hours in a day. So I really got a ton of value out of that book.
That's great. I have not, I don't think we've had that one, Spencer. So I'll have to download it. I'm more of an Audible guy to do while I'm running, but I will definitely check that one out. So thank you so much. This has been great. And I think we'll call it a show. Thanks for being on the Wealth Flow.
Yeah, honored. Thanks so much for having me on, Keith.
Thanks, Spencer.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.